Introduction to Consolidations, Chapter 4, General Intragroup Transactions. Let's quickly have a look at the consolidation process as you would have seen it being applied in the previous chapters. The first step in the consolidation process is to obtain the separate financial statements of the parent and its subsidiary. That will always be your starting point from where you will prepare your consolidated financial statements. You have to consider if the reporting dates of the parent and subsidiary are the same and if uniform accounting policies have been applied. If not, adjustments would be necessary. This then forms your starting point where you would now, line by line, start adding together 100% of the balances of P to 100% of the balances and totals of S. The next step, consider whether the identifiable assets and liabilities of the subsidiary are fairly valued at acquisition date, is the topic of Chapter 7. In all the examples leading up to Chapter 7, there is a sentence included that states to accept that all the assets and liabilities of the subsidiary are fairly valued at acquisition date. Only when we get to Chapter 7 will we see what the effect on the process is when it's not fairly valued. To give effect to the single economic entity principle, we then said that those combined balances and totals of the parent and subsidiary as my starting point have to be adjusted for the effect of consolidation journal entries. The first consolidation journal entry that we spent some time on was the at acquisition consolidation journal entry, through which we eliminated the parent's investment against the at acquisition equity of the subsidiary as them being common items. Together with that, we also recognized either a goodwill or gain from bargain purchase, if any. Chapter 3 focused quite a bit on non-controlling interests and measuring and recognizing this balance in the consolidated financial statements. Because NCI is an equity participant of the subsidiary, all the movement in the equity of the subsidiary had to be attributed to this NCI. That included attributing a portion of the current year's profit or loss of the subsidiary to NCI, as well as identifying non-controlling interests in the net assets of the subsidiary as part of the at acquisition consolidation journal entry, and also as part of the since acquisition date process, where a portion of the since to opening balance equity items of the subsidiary have been attributed to NCI. A further step will now be added to this consolidation process in Chapter 4, and this further step will lead to more consolidation journal entries, and that would be necessary for purposes of eliminating intragroup balances and the effects of transactions between the parent and the subsidiary that do not result in profits or losses. A parent and subsidiary often enter into transactions with one another for various business reasons. A parent can, for example, lend money to its subsidiary, then there will be an intragroup loan with intragroup finance costs and finance income. Or the subsidiary can buy inventories from the parent, or the parent can buy inventories from the subsidiary. Furthermore, it often happens that the parent charges administration and management fees to its subsidiary for general services rendered to the subsidiary. So examples of intragroup transactions and balances include the following. You can have rent paid and rent received, the loans that we've mentioned and the corresponding finance cost and finance income, management fees paid and received. Then you can have a situation where there's a dividend declared or paid by the subsidiary to the parent. Remember, the parent is an equity participant of the subsidiary. So if the subsidiary declares a dividend, some of that dividend is payable to the parent. Intragroup sales of inventories is the topic of chapter 5, when we will spend some time on that, because that is transactions where we do end up with profits or losses in the separate entities. Intragroup debtors and creditors as a result of these transactions where amounts have not yet been paid, and then intragroup sales of property, plant and equipment, which is the topic of chapter 6 and outside the scope of FRK 201. In the separate financial statements of the parent and the subsidiary, your starting point of the consolidation process, all of these items represent normal business transactions with third parties and are accounted for as such. These transactions may even lead to profits or losses in the separate financial statements where we're buying and selling inventories. But one should, however, remember the following very important principle when looking at my group financial statements. The parent-subsidiary combination is known as a group that we have now mentioned a lot of times. And this group is now a single economic entity. And to give effect to the single economic entity principle, only transactions between the group, which is represented by my red block, and parties outside of the group, third parties, is allowed to be presented in the consolidated financial statements. Any transactions entered into between the parent and the subsidiary inside the red block are therefore within the group. And these types of transactions between the parent and the subsidiary are known as intragroup. And from the group's point of view, these transactions cannot be recognized in the consolidated financial statements because it's not considered to involve third parties outside the group. It would be as if the company entered into transactions with itself, coming from that single economic entity principle. And therefore, the effect of those intragroup transactions have to be eliminated. And through chapter 4's discussions and example, we will now see how we will eliminate the effect of those transactions and the effect it will have on the line items in the consolidated financial statements.